Well, I think it would be premature to say things are over, Martin. It's clearly an unfolding situation, and events are moving at a fast pace. My focus, of course, is on Asian markets, and so we really are thinking and looking at what's happened in the U.S. and also in Europe through the lens of how that impacts the markets that we're focused on. And I think the framework here, if we weave in the recent events for UBS and Credit Suisse, is similar to what we have just been focusing on last week, and we actually wrote a piece about this. And I think the framework, which is helpful for investors, is that we need to think about things in terms of three shocks that have happened. There's obviously, first and foremost, a financial stress shock, and that's manifested then in an interest rate shock, and then that also likely has some sort of a growth shock. And that speaks to what Bob Pisani was just saying, because the market seems a bit schizophrenic in terms of how it's traded the U.S. sectors last week, and that reflects varying aspects of these different shocks in terms of growth and rates. One of the key points we've been making is that if you looked at things solely through the lens of interest rates, then you would come to, I think, an unduly optimistic view on markets, because, of course, lower interest rates is generally better for markets through valuation and portfolio flow conduits. But you really have to take advantage or take cognizance of the financial stress aspect of things, and that's why the broader concept of financial conditions is really important, because financial conditions includes not just interest rates, but also credit spreads and the dollar, and to a degree, equities.
And they have tightened significantly.
Well, this is the whole point. Yeah. So when we look at our financial conditions index, it actually tightened on an aggregate basis, whereas interest rates fell very dramatically in the U.S. last week, as you saw. Yeah. And if you strip out the equity component, so you don't sort of pollute your equity analysis, we're looking at what equities did, they eased much less dramatically than they did if you just look at interest rates. So our key point, wrapping all this up quickly, is that we've seen this shock in terms of broader financial conditions. We've also lowered our U.S. growth forecast by 30 basis points last week. Our U.S. economists did that because the smaller banks account for about half of the commercial industrial lending in the U.S., as well as real estate, both commercial and individual lending. So there's going to be some sort of a hit to growth. I think the contrast is that we actually raised our China growth forecast last week from 5.5% to 6%. And we've also seen that the PBOC has eased reserve ratio requirement by 25 basis points, in sort of maybe on a prophylactic basis, just introducing some more liquidity. So our sense is that you really want to be focusing more within Asia on the parts of the region that are more focused or exposed to China, and less on those that currently are more exposed to international.